Hey, what's up, stock compounders? Brad here. So, Rob Vinall of RV Capital just released his 2021 letter to investors. This is something I look forward to. It just comes out twice a year. He does a half year letter and then kind of a second half year letter. So, this is covering the second half of 2021. And he does make a new purchase, okay? And he doesn't do that all that often, so it's very exciting. And it's actually down a lot in price since he bought it. So that makes it even more exciting to me. And we'll get into what that is. But let's just work our way quickly through his 2021 letter. There's also this cool thing where you can listen to someone reading the letter on Spotify, the Rob Vinall podcast. So check that out if you prefer to consume content in an auditory way. Okay, so things of note here. I like to look at the compounded annual gain since inception. Okay, 19%. So that's pretty impressive over the last 13 little extra 13 plus years, 19%. And then let's see. Well, he's comparing to the DAX. It'd be nice to see the S&P, benchmarked here as well. But 19%, definitely better than the S&P over that time frame by a couple percentage points. So let's see. New investment, right? So this is interesting. Right off the bat, I wrote in my first half letter of 2020 that I was keen to invest more in what I termed early stage growth companies. Okay. He was able to find one because of the current pessimism surrounding fast growing companies and have added one new investment: online used car retailer Carvana. Okay, many of you are familiar with Carvana through Cliff Sosin of CAS Investment Partners. And that's how Rob Vinall was introduced to it in 2018. So I guess Cliff really shared kind of his framework, his thesis for how he thinks about Carvana, and it helped get Rob Vinall up to a comfortable understanding, at least enough to take a position in it. So Carvana, the largest e-commerce platform for buying and selling used cars in the US, co-founded in 2013 by CEO Ernie Garcia. Likely sold over 400,000 cars at retail in 2021. The total used car sale market in the US is around 40 million units. So it already has a 1% market share. Small share of an enormous market. So that's where we get back to early stage growth companies. Rob Vinall thinks there is a lot of room to run in the used car market for Carvana to grow into. He gets into purpose. The purpose of Carvana: provide a better value proposition to consumers along the three vectors that matter most: value, selection, and customer experience. So I'm not going to go too deep into this. If you guys are interested in Carvana, definitely dive into this. I'm just going to touch on a few pieces here. Vertical integration. Okay, that's really what Carvana, how it's differentiating itself from a lot of other online car peers. So why are we invested in Carvana? Whenever I evaluate a business, the place I start with is the people. Okay, most value investors probably start with the numbers. Okay, sort of a quantitative analysis of a business. Rob Vinall starts with the people. What is the culture like? Okay, what's really driving the CEO? In Ernie Garcia, the CEO of Carvana, we are partnering with someone who combines a deep love of the business with mastery of automotive retail. In 2018, he gifted part of his stock holdings to all employees with more than 1 year tenure. So it kind of talks about how clearly the CEO cares about his people and wants to reward them. for performance. Mastery comes from deep domain expertise. As the son of the founder of Drive Time, a large subprime auto dealer and lender, he grew up around the used car business and has led Carvana's development since day one. The guy's only like 39 years old, okay? So the CEO has a long way to run, hopefully, as well, which, is a definite perk here. He is one of the handful of founders. Now, this is speaking very highly of Ernie. One of the handful of founders, including Amazon's Jeff Bezos and Shopify's Toby Lutke, that I never tire of hearing speak. Okay? So, singing his praises. It's rare to find a CEO who both cares deeply about a business and is uniquely placed to lead it. It does not seem too much a stretch to imagine that Carvana is his life's work. This is exactly what I look for, what Rob Vinall looks for in a CEO. An emerging moat. So there's three main sources of competitive advantage: scale, brand, and culture. Again, I'll let you guys read through those if you're interested. An attractive price. Ultimately, no matter how good a business is, it only makes sense as an investment if it can be bought for less than it's worth. This means estimating its long-term cash-generating ability, discounting it to the present to arrive at an intrinsic value, and comparing that value to the current price. Please note, although the output of this exercise is necessarily quantitative, the input is mainly qualitative. What drives the valuation is the qualitative belief that a combination of people, competitive advantages, and market opportunity will lead to a large and flourishing business. So a divergence there from what I at least hear most value investors talking about in terms of how they value a business. So here it gets to where Rob Vinall thinks this company could be in 5 years, selling 2 million used cars at retail, $30K revenue per retail transaction, net income margin, which gets us to fair value. Okay, so 96 billion fair value estimate in 5 years. Okay, that's really what Rob Vinall is targeting on the horizon. That's a 20x multiple of 4.8 billion in net income is how he got to that number. And what is the market value today? Well, it's gone down quite a bit since Rob Vinall seems like he bought in. We can take a look at a price chart here for Carvana. I mean, it was up at, what is this, 360 back in August of last year, okay? And it's down to, well, I'm going to move this for you, 146, okay? So it's just gotten pummeled in the last handful of months. You can see the market cap. It looks like when Rob wrote this, it was 25 billion. Now it's half that at 12.5 billion. So, if it's worth 96 billion in 5 years, that's nearly an 8x, okay? When Rob wrote this up, it was a 4x in 5 years. Now it's potentially an 8x in 4 years or 5 years if you agree with the assumptions that Rob Vinall is making in terms of, how this business will grow over the next handful of years. So that's compelling. He points out they'll likely still be reinvesting into the business, into growth. The point of the margin assumption is to get a sense of the underlying cash generating ability of the business. Let's see. Talks about the growing internet penetration. I expect the internet to continue to take share from in-store, as has already happened in many other retail markets. The value proposition is just better. Okay, and he talks about why that is. This was particularly interesting. virtually every aspect of Carvana's business model scales. Okay, so he's really talking about how, when you get these brick and mortar car retail businesses, it's very hard to scale those. It's part of the reason there's so much fragmentation in the used car market. But if you can attack that market online, there's so much more ability to scale and capture a major chunk of the market share. So that's kind of what Vinall is pointing out there. Additional revenue opportunities is kind of the cherry on top, in addition to just the retail sales of these cars. Marketplace for third-party vehicles on its platform, car insurance, car loans, all that kind of stuff. And then last part with Carvana, in my experience, the surprises in great companies tend to be to the upside. If my qualitative analysis is correct, and the CEO really is in this tier with Bezos and Lupke, I mean, great things could happen. He's optimistic this will be the case at Carvana too, where the surprises will be to the upside. Okay, so that's the Carvana piece. The second part is Moat versus execution. And I found this very insightful. So people talk about moats, right? Like when you're starting a business, almost like you've got to figure out what your moat is before you even start the business, right? But that's not how it works in reality. This is a quote that has really driven Rob Vinall's investment framework since inception here. This quote from Ben Graham: "Investment is most intelligent when it is most businesslike." And he points out here a few differences between, business owners, entrepreneurs, and investors. And there's some divergences here that Rob Vinall thinks present an opportunity for investors who are able to think like business owners. And he calls his fund business owner, okay? Because it's how he wants to communicate what he's doing to his investors. He's treating these investments as if he's the business owner, right? Which technically he is. He owns shares, but most people don't quite take it that literally. The importance of people. One such area is people. Entrepreneurs place far more importance on people than investors do. Okay, I think that's really important. I have never met an entrepreneur who does not believe that the success of any commercial venture is mainly down to the people running it. Investors, on the other hand, rarely base their investment case on people and sometimes skip the topic altogether. I see that a lot. This is why people is my first investment criterion, though not the sole one. It is partly because it is important, but also because it is more likely to be a source of market inefficiency. Okay? Because people aren't paying enough attention to this aspect of what makes a business great, the people. To the extent other investors are paying less attention to it. Okay, so there's an edge to be gained as an investor, according to Rob Vinall, by putting more emphasis on the people behind the business. The importance of execution. Another area where I suspect there's a gap between entrepreneurs and public equity investors is the importance they place on execution. It is the topic I want to dedicate the rest of this letter to. Entrepreneurs view execution as absolutely central. Investors, by contrast, tend to view execution as a subordinate importance to competitive advantage. Okay? Harvard economist Michael Porter was the first advocate for the centrality of competitive advantage and wrote 2 books on the topic. I mean, you hear Buffett talk about moats all the time, right? It seems like he talks about moats and competitive advantages much more than he talks about execution, operational effectiveness. It is a view espoused famously by Buffett, no doubt informed by his early travails with a failing textile mill called Berkshire Hathaway. Buffett says, I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later an idiot will run them. I have never felt comfortable, this is Rob Vinall, with the idea that operational excellence is less important than a competitive advantage, as it is at odds with my direct investment experience. The best companies I come across differentiate themselves by making small incremental improvements to their business every day, as opposed to being insulated from competition through a moat. Okay? Now this idea of small incremental improvements every day, I mean, it's really just that the story of compounding, right? If you make a 1% growth each day for a year, that's like a 38x in improvement. Okay, so it's these little steps each day. And I really resonate with the message that Rob Vinall is putting out here. That it's actually, not this moat that means you can kind of sit on your laurels as a business, but it's actually these small incremental improvements each and every day, getting really smart people, hardworking people together, attacking a difficult problem, making progress on it, that results in a moat. Okay. So he talks about a few different businesses that have opened his eyes right to this point. Moat is an output, right? As these companies have grown, they have gained scale, harvested more data, and enhanced their reputations. The result is multiple competitive advantages. However, these competitive advantages are the trappings of success, not the cause. It is like observing a successful business person who drives a Ferrari and arguing that they are successful because they own the Ferrari. Does the importance of execution wane over time? Once the competitive structure has formed into a steady state, execution diminishes in importance, and the benefits of a strong competitive advantage come to the fore. The validity of this argument depends, though, on how stable a sector's competitive structure is expected to be over time. If the assumption is that a sector's structure is basically fixed and there's no prospect of change through technological or business model innovations, then having a competitive advantage probably is of paramount importance. However, how frequently is that the case today, right? In a world where technological change is accelerating, most sectors are in a state of flux. As such, it is far better to be permanently working on getting a little bit better every day, rather than relying on a competitive advantage derived from past glories. Okay? I think this is really the crux of this second section here. This is what creates enduring businesses, to be constantly engaging on getting a little bit better every day in terms of delighting the customer, rather than resting on one's laurels. And here he goes out and says, it may even be a handicap to have a competitive advantage, to think that you can rest on your laurels. The argument could be made that too strong a competitive advantage is even detrimental when a market is in flux. Which company is more likely to fight every day to meet customers' constantly changing and expanding demands? One which believes it has a birthright to outsize profits, or one which understands that the customer's trust needs to be won afresh each day? Okay, clearly the latter. And then we're almost done. Tackling hard problems. So the question is, what's the guiding principle that pulls the company towards both a widening moat and ever greater efficiency? What would cause a company to be compelled to make these small improvements each and every day? Tackling hard problems. Tackling hard problems or complexity is a candidate for such a guiding principle. It requires a singular focus on execution. Moreover, the harder the problem to be solved, the wider the moat will likely be. As a guiding principle, it resolves the tension between moat and execution in a way that a singular focus on building competitive advantage does not. Tackling hard problems. And then the CEO of Carvana, Ernie Garcia, did a podcast with Patrick O'Shaughnessy, Invest Like the Best podcast. I'm sure many of you are familiar with it. So check this one out, especially if you're considering investing in Carvana. It's a 1 hour and 13-minute interview with the CEO of Carvana. That's something you could easily search for. Disrupting the auto buying experience. Okay, back to the letter. Right, so Ernie talks about this point of complexity or tackling hard problems. I think complexity is, to me, a really good property if you're trying to build something really big, but it's also a property that decreases your odds of success. Complexity generates a higher likelihood of failure, but it also generates, in my opinion, the most important and persistent and durable moat once you clear it. So I think, to me, complexity is a function of how big a swing you want to take to some degree. And so this thing that Carvana is trying to tackle of electronically registering cars online, working with the DMVs across every state in the U.S., that is not a problem I envy tackling. I will tell you that right now. DMVs, it's probably the worst, among the worst customer experiences that I've ever had going to the DMV, which therein lies an incredible opportunity, right? How many people would buy a car just simply through Carvana because they don't want to go to the DMV? I don't know that that's actually an understatement. I'm curious, people in other countries, right, outside of the U.S., what is your experience? What's the equivalent of the DMV where you are, and is it as awful as it is in the U.S.? I'm very curious to get a little more perspective on that. So, talking about different problems, nothing on the surface is sexy about this problem. But it's incredibly interesting when you dive in, and I think that's another really important thing to try to be successful, is when you find these complexities, can you find great people that want to tackle superficially sexy problems, and can you get those people to be like, hey, but wait a minute, this other problem that has no sex appeal whatsoever is actually even cooler, because it's got the same complexity as the sexy problem, but no one's tackling it because it's not sexy, and we can make an even bigger impact here. That really resonates. It's like Pabrai talking about the funeral services business, right? There's not a lot of college grads who want to go out into the world and tackle that problem, tackle that industry, start a business in the funeral services industry. It's not sexy. It's the opposite of sexy. So there's potential opportunity there in those unsexy areas. Let's see. I'll just leave it with this: the importance of hard problems. The implication is that it is not enough simply to have a moat. Companies must also have plenty of hard problems left to solve. Okay, this is what prevents them from resting on their laurels, kind of leaning up against this moat that feels like it's going to be enduring, but it's only enduring if there's constantly these hard problems to tackle, to kind of continue reinforcing that moat. Only then can they continue to attract ambitious people. Only then are they forced to improve their execution every day. And only then can they widen their moat further. A company that has solved the customer's problem is a sitting duck in the crosshairs of the next technological innovation, irrespective of how wide its moat is today. Brilliant. Love this. So, that gives you a great flavor for what Rob Vinall's half-year letters are like. So, big shout out here to Rob Vinall. I don't know yet if Carvana is a company I'm going to be taking a deeper look at. Let me know in the comments if you're intrigued by Carvana now or if you already own it. I'm curious to hear from you guys what your take is on Carvana, especially if you've used it before. My dad actually used it, I think maybe last year or the year before, and he had a fantastic experience selling his car on Carvana. He got, I think, a couple thousand more from Carvana than he was being offered from any other source. So at first that was a little bit of a red flag, like, ooh, is this a sustainable business model? Are they paying too much for these cars? And I kind of wrote it off, assuming that, but maybe it's time to take another look at Carvana. So that's it for this one, guys. Hopefully you enjoyed this kind of overview of Rob Vinall's latest letter to investors. And yeah, that's all I got for today. Thanks for watching. I'll see you in the next one. Take care.